Now let's talk about the informal savings instruments that poor people use when they don't have access to financial services. They manage a collection of instruments according to a number of clear trade-offs. The first one is the obvious one of risk versus return. The second one, which is the one I want to concentrate on here, is on the one hand the need for flexibility to be able to adapt your savings patterns based on evolving circumstances, with, on the other hand, the need for discipline to maintain the course so that you can meet the objectives you set out for yourself. There's different types of discipline that are required to maintain savings. This is my savings instrument. On the one hand, I need discipline in. And there are a variety of mechanisms built into informal savings instruments that help me save. On the other hand, I also need to make sure that I don't liquidate this savings prematurely, because I need discipline out. These are features that informal savings instruments have that help me keep it saved. Once I've made the effort to save money, please don't let me raid that savings too easily. The kind of instruments, informal instruments that have these help me save characteristics that instill regularity of savings are, for example, the Rosca, where I set myself an obligation to set aside a certain amount every month or week, and the discipline mechanism is peer pressure, since it's a public commitment that I do with my friends and neighbors. Another one is when I buy something on credit. When I buy a bicycle on credit, I've now set myself the obligation to repay that loan every week and every month. I need to set money aside. It's a post-payment of that bicycle. Even physical assets like cow entail some discipline in, because to preserve that value of the cow, in fact to grow it, I need to be feeding that cow regularly. In terms of discipline out, the mechanisms that informal mechanisms have to maintain discipline once I've saved are many, and we're going to illustrate them here with reference to the cow. So imagine that I save in cows like this one, and we can define three different types of mechanisms through which I'm going to be disciplining myself, so that once I have the cow, I'm not going to be saving so easily. The first one have to do with transaction frictions that are represented in the cow. One example of that is indivisibility. The fact that I can sell the cow if I need to, but what I cannot do is sell a part of the cow. So it's not going to be a very good way to fulfill small liquidity needs. And hence saving in a cow is going to help me avoid small temptations. Indivisibility works at many levels. Here it's an actual transaction friction, but it's also mental in many ways. If I save money under the mattress, I might put in $1 bills, but when I have 10 of those, I'll change it for a $10 bill. And when I have 10 of those, I'll change it for a $100 bill. Mathematically, nothing has changed, but psychologically, it's a lot easier to pull out $1 from under the mattress than to break 100. The second type of transaction friction that is embodied in the cow is the notion of delayed liquidity. Because I can sell the cow, but perhaps not immediately. I might need to wait until the next market day. So this helps avoid impulsive decisions. I cannot act on impulse immediately because I cannot liquidate the cow immediately. The third type of transaction friction is actually the actual transaction cost of selling the cow, which acts like a penalty. This is both in terms of the time and effort that it takes for me to take the cow to market, but also the implicit loss, the bid-ask spread, which is the difference between the price at which I would sell the cow to realize the liquidity, and the price that would need to to buy the cow at if I wanted to replenish that savings, I'm actually going to lose a little bit of money there. And so given that penalty, I'm not going to be wanting to do that very often. It's going to be acting as a brake to my temptation to use that money. These are more economic type of restraints to against my raiding my own savings. But there's some characteristics of the cow that operate at the purely psychological level, which we can call mental labeling. For example, I am likely to associate a clear purpose with those cows. I'm going to be telling myself these cows that I'm saving in are for the wedding of one of my children or for my own retirement. And by putting a clear mental association of those cows with a clear purpose that I desire, it's going to make it more difficult for me to want to use the cows for some other purpose, to raid the value of the savings in the cows. Another type of mental labeling is about not thinking about those cows as savings at all. In fact, to look at them as investments. Investments are things that are vested with higher significance than savings. Savings are, at the end of the day, instruments for an ulterior purpose, whereas investments have value in their own right. So if I manage to think of the cow as an investment, I'm going to be less tempted to liquidate the value. It's certainly going to help of me thinking of the cow as an investment because it produces milk. The actual return on the cow may be higher or lower, but the fact that I look at the cow as a productive asset, because it produces milk from time to time and I can use it to plow the fields, it helps me to think of it as an investment. I'm not mentioning here the economic return as an investment. The return may or may not be higher than regular savings, but the fact is that mentally I'm associated as an investment, and that acts as a brake to my selling the cow. And then there's a third category of restraints against my early liquidity, exercising early liquidity in the cows by selling them, which we can call social inhibitors. These are not economic and they're not psychological, meaning it's a trick that I play with myself. This is actually the social context in which I'm making that saving. The first example of that is if the cow has some special social meaning. This might come from religion, where the cow has ceremonial value, and so selling the cow has higher. The stakes seem a lot higher, or it might be more of a family tradition to think of cows as symbols of fertility, and you want to be associated with these things in your family. The second social consideration is that the cows are a public form of savings because they're highly visible, and so they have display value. The social value of the cows is higher than the direct economic returns from the cow because I use it to show the community that I'm successful, I'm looking after the family, and through that I may be able to exercise higher power and influence in the community. And because of that, there's a form of peer pressure that is going to inhibit me from selling those cows, because it's a very public at that point. This saving, if I sell the cow, the whole community will get to see that I had a moment of weakness or a moment of need, and so there is an element of social monitoring, which is a form of peer pressure. So we see here that there's in fact a third trade-off, which is a very important one, which is the trade-off between keeping the savings social and visible, like we just saw with the cow, and we just went through the benefits, with the need for privacy. Because making your savings very public does have its costs. If the whole town gets to see that you have a lot of money saved, they might be calling on you in moments of need. Then there might be a lot of social pressure for you to share those savings with people in need. or to make higher contributions to the village at the time of the annual festivities. And of course, you might be drawing more attention for thieves. So the social privacy considerations are a trade-off that the families need to manage. So that's what we can see here is that there are a lot of inbuilt mechanisms within the cow designed to not only help me save by having to maintain the value in that investment by regular contributions to the welfare of the cows, but to help me keep it saved because there's these frictions, mental, psychological mechanisms, and social inhibitors to the saving. So in this trade-off here between flexibility and discipline, the cows may be closer to the discipline element because all of these are kicking in. That's not to say that's necessarily the only thing the family wants. It might also need to balance that out with liquidity, and so it'll complement the savings in the cow through savings in other instruments which are closer to the flexibility end. If we just take the analogy of the animals in the farm, there might be a pig that is smaller in value, more immediately sellable, has no social value, and it's harder to see as an investment. Or the goat, or the chicken. So families will manage this trade-off by choosing the right amount of the different types of instruments that they'll be holding. This, of course, also operates for non-animal forms of savings. The jewelry might be here, Rosca might be here, and so on. So what does this mean for formal financial services? If we have a bank that is wanting to offer savings services to poor people, right now they only know one way to offer discipline in those savings products, and that's largely around time, forcing you to commit to a certain pattern of savings, or to locking up your money. You don't have access to it until a certain date. People resent that because it feels like it's a bank talking down to them, and it's only a couple of these mechanisms that we see here operating, largely the transaction frictions going on, and not playing much with social or psychological tricks. What is remarkable about this informal mechanisms? They're not about external discipline. They're really about much more of self-discipline, hooks that are built into these instruments that help me keep the money saved. So lesson here for banks might be two. One is how do you incorporate many more of these types of savings discipline mechanisms into formal financial services, and secondly, how do you present it so that the bank is offering you ways to discipline yourself rather than it being presented like the bank is wanting to discipline you. This lays out the challenge for advanced savings services that meet the needs of the poor.